So is the angel investing round before like the Series A, Series B?
Okay.
How does that timeline work?
Okay, well typically, I mean, Series A, Series B, Series C, it just refers to what round it is. So your Series A is your first, your B is your second, Series C. Typically, they go up in value. So the idea is you want to do an up round every time. You don't want to raise $1 million saying your company's worth 10 million and then raise another million saying you're worth 5 million. So that's why you notice the up raises, because that just shows your company is successful, really.
So
angel investors could come at any round though. So typically, depending on the angels you talk to, angel rounds, say, what do you say, 200,000, I guess they go down like 50,000 to
barely, yeah.
5 million would be your angel rounds.
Okay.
Then venture capitalists.
Yeah, and then after that, venture capitalists, which you use the same type of pitch for a venture capitalist as well. And venture capitalists will typically do your $10 million rounds, $50 million rounds. But you have to keep in mind too, these people typically you don't just get one angel investing in your company. You usually get either nobody investing in your company, or one person will go in at 500,000, their buddy will match them at 500,000, and you'll get 5, 10 people in on the round, or 2 people even. So typically it's not just one person.
So how did your pitch work out for?
We killed on the pitch. We actually did very well on the pitch. We got the next round of meetings, but through the due diligence process, they didn't think we had enough sales history, and they didn't think they wanted to invest $500,000 into college students. So they're like, okay, I love your product, love your vision, where you're going, but yeah, right now we can't invest, but let's stay in touch, and maybe if you guys really get your sales history up and prove you can pull us off, we'd be interested at a later date.
So that's a really big difference in pitching to real investors and pitching like the Burton D. Morgan playing competition. Like, they didn't give a shit, to be honest, about like, oh, we're in the Entrepreneurship Club, like we're industrial engineering, blah, 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 all the gold stars. They're like, well, have you worked in the beverage industry? Like, do you have experience there? The answer is no. So that's why we didn't put that stuff. But in the business plan competition, they love that stuff. Like, you're a treasurer of whatever, and
Yeah.
it's like experience, but it's not really relevant. So you gotta take note that it's different depending on who you're
You gotta
pitching
always
to.
know your audience, and this is for if you're pitching to investors, if you're doing the business plan competition, like you said, talk about your club status and stuff like that, say like that.
So are you guys like on track to hit your goals then?
For our sales?
Yeah.
Not really. We're pretty stagnant right now, so we're back to being full-time students, so we're not really sure where we're going with it.
Oh, okay, gotcha.
Any other questions? You want to run down how valuations of companies work and all that?
Sure.
Okay, so.
How about you talk about alternative financing,
Okay, yeah.
which goes along the same line?
I guess, yeah, one other thing to note, like I was talking about, typically your angel investors, you don't go after them until you're actually cash flow positive, you're showing some serious growth. And even then, oftentimes you just meet them at networking events and you stay in touch with them over the course of 6 months to a year, and they build interest that way and then eventually invest. That's the ideal way to raise financing. So you don't want to just go out there, start pitching every group you can, and essentially try to raise financing that way. Ideally, build some relationships, stay in touch with these people over a long period of time, and eventually, like I said, about an average of a year, these people will want to invest. So don't expect to just go out there, pitch, and then close. It just doesn't work like that. But also there's alternate financing. So, you can talk to your friends and family. That's always a good place to start for seed financing. You need a couple hundred here, a couple hundred there. Additionally, if you guys know about crowdfunding, Kickstarter.com, Indiegogo, essentially what that is you can make a video and promote it, and people can donate small amounts to your cause, in this case your business, and you can fund that way. And there have been successful campaigns that have raised, I think tops like $10 million that way. But with that, it's not easy, so don't think just because you're going to make a video, you made a sweet video on iMovie, that you and your friends are going to go out and raise $10 million with your product. It's actually very difficult. So, I mean, it's a good route, and you can raise a couple thousand decently easily. But really, if you do a crowdfunding campaign, plan it out very well. Make sure you have PR. So PR doesn't come naturally. People think, oh, like news people just pick up stories and then run with them. Typically, PR is very structured, and you're submitting stories to people. You have connects submitting stories to people, so you know someone who's at a PR agency, or someone who has a connect at the New York Times, and they'll forward your story on. So make sure when you do a crowdfunding campaign, you really plan it out, because it doesn't just go viral, as they say. It takes a lot of work behind the scenes. But that's also a way to go about it, is alternative financing. And it can be great for kind of small financing to get you to the next step, or to keep your business afloat, or to get a prototype out there on the market. And then in terms of for how valuations work, they say valuations for startup companies, it's an art, not a science. So with like private or publicly traded companies, you have stocks, right? The values are determined by what people pay for on a stock exchange, going up and down, and it's essentially a science. Whereas with privately held companies, there is no stock exchange. So your value is what you can convince someone to pay for your company, right? So it could be anything. Essentially, you just pull it out of a hat. Like, okay, we're gonna be worth 2.5 million, right? How do we justify that? So you have to look at essentially how much equity you're willing to give up in your company, how much money you actually need. So you don't want to just say, oh, we need $1 million when you do your financial projections, go, wait, we only need 250, right? So make sure you actually are only asking for how much you need. And then from there, it's a process of convincing them that your company will be worth that much. So you saw in our financial projections, we said, okay, we're gonna make 10 million in year 3. We can expect a 10x or 5x multiple on that. And we're currently valued at 2 million. So that means you're gonna make 20x on your exit in 3 years. So typically they're looking for, I mean, they say like 5 to 30x in 3 to 5 years, but realistically, I think it's like, actually turns out to be like 2.6 in 3 years or something like that. You can Google it. But you're trying to show, look, you're gonna make 5 to 30x in 3 to 5 years with a clean exit.
So, when Snapchat had like a $50 million round, right?
Mm-hmm.
But they only raised 7.5 million. Does that mean the people within Snapchat then had 48.5 million? That's how much their shares were worth.
Yeah, exactly.
Okay.
Exactly. So when you say you raise it, you're 50. Yeah, Snapchat valued at 50 million. They raised 7 million. That means the rest of the company is worth 43 million. That's what all the shares are worth that were there before,
Okay.
right? And so you have to have, the reason you have a pre-money and a post-money valuation is because, look, you just raised $30 more. So your company is inherently $30 more valuable than it was before, right? Does that make sense? That's why they do that. Because if you raise $10 million and you're saying, oh yeah, we were worth 10 million before, you're not going to be worth 10 million once you have $10 million in cash as assets, right? So you have a pre-money and a post-money valuation. It's based on shares like that.
Don't you typically give up equity in turn, like in exchange for fundraising, right?
Yeah.
So if you are raising larger and larger amounts of money, wouldn't that mean that your share becomes very diluted as the company grows?
Yeah, exactly. So the way you typically do it is you issue more shares. And so with that, you dilute. So this is your first round, right? This is your Series A or your Series C, right? Series A. And, right? Maybe we can do that, right? Yeah. So then, yeah, you want to raise another $100, right? So then you're going to issue them another 50 shares at $2 each, right? So now there are 150 shares. 150 shares, and they're all worth $2. Your company is now worth $300 post-val. And you only have, so there's 300 shares, or there's 150 shares. You previously had you still have 70 shares, and they're still worth $2 a piece, but your percentage is lower. Like you said, you're diluted. So that's where the dilution comes in, and that's why you have to think in shares, because that's how you actually issue it. Even though it's easy to talk percents, and when you're doing your pitch, you can talk percents. When you actually get down to presenting your term sheet and say, look, this is the deal. We're going to give you X number of shares at X dollars, you have to do it in shares because that's essentially how you have to issue it as a corporation. You can't say, here's a stock certificate for 8%, boom. Right? It doesn't work like that. So, and that's where you usually
typically someone like Mark Zuckerberg has done really well in terms of not giving away his company. But even the lady who Spanx, who's one of the most, she ended up with just over 50% of her company. So almost never do you have a 51% share overall.
Yeah. Yeah, and with that, you have to keep in mind too, it's not like every share is a common share. So you present a term sheet, so essentially you're talking to people. You have to realize investors, they're just people. So you're essentially just negotiating with them, okay, what are the deals? What works, what makes you happy and makes me happy? And with that, you can do a number of things. There's traditional things you do, which you can have, board seats. So you can say, hey, I'll give you 20%, and they're like, whoa, 20%, I don't have control, right? You say, but hey, I'll give you 2 board seats. So now you have control of the board of directors, even though I have control of the stock. And then you essentially set rights for each one. So you say, with a vote, a stock vote, you can do X number of things, but you need a board, majority board vote to, let's say, raise additional capital or issue more shares. Does that make sense? So you can negotiate terms that way. So like you can end up with 70 shares, but 100% of the voting shares because you issued them Series A class stock, which isn't allowed to vote, right? But because it's not allowed to vote, if the company goes bankrupt, those shareholders get paid back first. Does that make sense? So you can throw terms like that around, and that comes into play also. Like I said, they don't want to lose money, so those are the things you can do really easily to help them not lose money. So say, hey, look, we'll issue preferred stock that is backed by all the assets of the company, so if we go under, you get paid back first before I do. Or you can say, okay, we're looking to raise $1 million, but we're college students, we understand that, so we really only need 100 grand to get to the next stage. So let's set a milestone. If we hit 1 million users by January 3rd next year, then we will get the additional 900 grand at X valuation. Does that make sense? So with these deals, it's not like Shark Tank where it's like, oh, 20%, 100 grand, take it or leave it, that's all we got. Like you can essentially mitigate their risk by structuring the deal based on milestones or stock classification, stock terms.
Allocating funds to specific things like manufacturing too.
Yeah, too. So you can like say, look, 10% will be guaranteed to go toward manufacturing, so we don't blow it all in marketing. Or so we have a certain amount of assets, backed by our inventory. And you can also do things like, okay, I want to raise 500 grand cash for equity, but I also want 500 grand line of credit for inventory purchases. So what that means is you're going to give us 500 grand cash now for stock, but you're also promising, should the company need it, you will supply up to 500 grand at a low interest rate of 1.8% specifically for the purchase of inventory. So you can essentially make up any kind of financial tool you need there to show them, look, we're not going to lose your money, it's fine, we're only going to use that extra 500 grand for inventory, stuff like that. Does that make sense? Any other questions about anything I went over today or financing in general? So,
how did you do your market research?
what's up?
How did you do your market research to get
Market research? Okay.
Because like you can come up with a figure and be like, I'm from Australia, so this could be a little bit different.
Mhm.
But like, how do you just sort of come up with figures? I understand there's like, isn't it Mintel and IBIS and that sort of stuff. Do those are they actually accurately reflect?
They're the most accurate you have. So
Okay.
with that, you have market research documents. Companies, their whole job is to put these out. They're supposed to represent the market, but really, they don't really. I mean, they're not necessarily accurate unless they do different, depending on the collection method and all that. But the idea is with market research, you just want to say, hey, look, there is a market for this, right? Whether it's a $4 billion market or a $5 billion market, it's like, okay, whatever, you still got a $4 billion market.
Yeah, I'd say more important than market research though is customer validation. I can put all the numbers in the world that say this is the best market to be in, but if I don't have customers who are willing to actually pay for it, it doesn't matter.
And how do you do that?
You sell them
Prototype and
something.
launch.
Yeah.
Yeah, prototype it, launch it in a small test market. Get people to pay for it early on in a small target demographic. So for us, our test market was Purdue. We said, look, we sold very well at Purdue. We believe we can scale this to other markets because we knew we didn't have enough funds to launch nationally, right? So let's say you have an app. You say we have 100,000 users now. We're targeting, it's only available in Indiana because that's the only place we have support for it right now. But with this funds, we're going to roll it out, and we expect to have those same usage ratios everywhere else.
Did you have a strategy in place to stop? Like, weren't you worried that someone could pick up your idea and just take it?
Yeah, I mean, with that, I'd say you're always going to have that threat. Things like IP protection can help you with that, so patents, obviously trademarks, branding, but it's kind of no matter what your business is, you're going to have that threat. And
being first to market's important on that too.
Being first to market, and then any barriers to entry you can put up, and also your brand. Your brand is one of your most powerful assets. Like, you guys all have heard of Snapchat, right? Facebook launched Poke, which is like the exact same thing, but Facebook's version. A couple weeks later, it blew up really quickly, and I now don't really know anyone who uses it. So, Snapchat had that brand, so that theoretically, I mean, it's a little early to tell, but theoretically helped fend off Facebook, who created essentially imitation product, and was able to market it through the Facebook app, so literally everyone saw it on top of their newsfeed. So, I mean, yeah, you're always going to have competition. You just got to compete, I guess. There's no really easy answer for that.
Yeah, it's hard to say, and one of the ones that I hear a lot is, like, everyone kind of talks with their patent. Well, two things. A patent isn't worth anything unless you've defended it, because you have no idea if it's really valid. And the second thing that goes along with that is there's almost always a way around a patent. So unless you're like a pharmaceutical company, patents aren't always the best thing to sell on. Just something to take note of.
That and a provisional patent doesn't mean anything. So if you have a provisional patent, that really doesn't mean anything at all. So it's not until it's actually issued, and even when it's issued, it doesn't necessarily mean anything either, like you said. You have to defend it to really say, look, this is valuable. People can't get around this.
Are there certain strategies that you take in place to get media attention and that sort of stuff? Like, or do you just kind of roll with it, see if you can...
Okay, so the strategy to get PR is essentially you want to have your story in line with what they're currently putting on the news and broadcasting. Right, that's how they usually pick up stories. So, for example, it was big in the news, 5 Hour Energy was like under scrutiny because they had a certain amount of FDA complaints. And it was a big national story. News stories or news stations wanted to run with it because everyone was doing a story on it, right? So the PR guy at Purdue goes, hey, look, I'm going to try to get you on TV because you guys are energy supplement experts, and this story's out, and people are trying to bring people in. So he shot emails to all his buddies in the agencies and all that, and said, look, I have these guys, can you get on TV? So our story coincided with what was already currently running in the news, and that's how you want to do PR.
And if you don't have those connections, where are some like cool places to try and find them? Like just universities, going to like
just talk to as many people as possible. Yeah, networking.
I mean, you can send it out like PR Newswire or whatever. But the guy at Purdue, his name's Jim Shank. His little goal is to get Purdue students on TV and gain national attention. So pretty much our contingency of him getting us on TV was one of us wore a Purdue shirt, and we said like Purdue's name pretty much.
Yeah.
He blew us up.
It's really just networking. A lot of those connections I really can't stress, are hugely important in any aspect.